In this knowledge clip, we will focus on how to classify a lease as either a finance or operating lease. Once we establish that we have a lease, we now need to determine how to classify the lease. IAS 17 classifies leases as either finance leases or operating leases. The key difference between these two classifications is the amount of risks and rewards incidental to ownership that is transferred. If there are substantially all of the risks and rewards transferred, then it would be classified as a finance lease. If the lease contract does not transfer substantially all of the risks and rewards of ownership, then it would be classified as an operating lease. The difference is easy to understand, but how do we practically apply it? That is, how do we know when substantially all the risks and rewards of ownership have been transferred? Determining if substantially all of the risks and rewards of ownership have been transferred requires the application of professional judgment and requires the consideration of the substance of the transaction over its legal form. IAS 17 provides some guidance by including 5 situations which, if present, indicate that substantially all the risks and rewards of ownership have been transferred. If any one of these criteria have been satisfied, then it would generally indicate that a lease exists, that being a finance lease. The 5 situations are as follows. 1. Where an ownership is transferred at the end of the lease term. 2. The lease has the option to purchase the asset at a price that is lower than fair value at the end of the lease, and it is likely that the lessee will exercise this option. 3. The lease term covers a major part of the asset's useful life. 4. At the start of the lease, the present value of the minimum lease payments substantially equates to the fair value of the asset. And 5. The asset is very specialized and only the lessee can use it without significant modifications. Let's go back to the example with Z Hiring and Sam. Assume that the tractor has a useful life of 8 years and the fair value of the tractor is $80,000. The present value of the minimum lease payments amounts to $47,500. The lease agreement does not give Sam the option to purchase the tractor at the end of the lease, nor does it transfer ownership at the end of the lease term. The tractor is not specialized in nature and can be used by other farmers in the community. Is the lease agreement between Z Hiring and Sam a finance lease or an operating lease? In order for it to be a finance lease, significant risks and rewards of ownership need to be transferred. We will use the 5 criteria provided in IAS 17 to determine if this has occurred. In terms of the first criterion, ownership does not transfer to Sam. Similarly, there is no option for Sam to purchase the tractor at the end of the lease term. The terms of the third criteria, the lease agreement, is for 6 years period, while the tractor only has a useful life of 8 years. Thus, this criterion has been satisfied since the lease term covers a major part of the asset's useful life. The fourth criterion has not been satisfied since the present value of the minimum lease payment is only $47,500 while the fair value is $80,000. Thus, the present value of the minimum lease payment do not equal substantially all of the fair value of the tractor. The fifth criterion is also not satisfied since the tractor is not specialized in nature. Therefore, the lease would be classified as a finance lease. This is because one of the 5 criteria for determining whether substantially all of the risks and rewards of ownership have been transferred was satisfied. Even though the other 4 were not satisfied, as one of them was satisfied, it basically indicates that a finance lease does exist.